February has been a very big month in the Kenyan financial markets. Investors are rushing into government papers, the equities are climbing, and new real estate projects are changing the investment landscape. So what should you be watching for? Hi everyone, welcome to Cytonn Weekly, and with me are investment analysts from Cytonn, Susan Chege, Ryan Masharia, and Ruth Margaret. Now, on fixed income, February recorded much higher T-bills oversubscription than January, even as yields declined. What does this tell us?
For the month of February, the T-bills were oversubscribed, with the overall subscription rate coming in at 267.2%, as opposed to the January, which was at 110.8%. So the oversubscription basically shows the investor confidence in the government securities. And even in spite of the nominal yields dropping, we see that the real returns at 4.5% still remain attractive to the investors. So in as much as the nominal yields drop, the real returns still remain attractive at 4.5% due to the decrease in inflation from 4.4% recorded in January to 4.3% recorded in the month of February. So for example, if you take the 364-day paper, which is at 8.8, and you calculate for real return, it still remains at 4.5%, which is attractive. Yeah.
Thank you. On equities, the equities market posted strong gains in February, largely driven by banking stocks. What does this indicate about which sectors contributed most to market performance?
The February's rally was broad-based at the index level, with the NSE 20, NSE 25, NSE 10, and NASDAQ gaining by 13.7%, 11.8%, 10.8%, and 10.6%. However, this performance was mostly concentrated in the large cap stocks, especially the banks, with Stanbic, KCB Bank, and DTB Kenya gaining by 29.5%, 20.6%, and 20%. This is reinforced by the 14.4% gain by the banking sector index, which outperformed all the other indices.
Thank you for that, Ryan. Now, on real estate, the report shows Nairobi's prime office yields were lower than Kampala and Dar es Salaam. Yeah. What does this suggest about investor returns and pricing in Nairobi's office market?
The lower prime office yield of 8.0% in Nairobi compared to 9.0% in both Dar and Kampala imply that investors are earning lower income returns compared to the property values they invest. In yield terms, this basically implies that the property values are higher compared to the rental income that these properties generate. And it could also mean that the rental returns are subdued, like they're stagnant. The flat trends in Nairobi at this time are 13.0 USD, that is for the prime grade A offices. And they did show a modest rise by a 2% to 80.3 from 78%. And despite all this, they still that stagnated or the subdued growth. When you look at Kampala and Dar, Kampala is at 16.5 USD and Dar is at 15 USD. And their performance can also be attributed to it's also supported by the increase in the occupancy levels. This generally implies that for the investors, the capital appreciation prospects are cautious, and also the rental returns they have been marginalized. They're going to reduce, and if you compare it to the regional peers, and for the landlords, now they have less bargaining power due to there's an oversupply in grade A offices in Nairobi, so it's taking away their bargaining power. For the tenants, this implies stable lease agreements with negotiating leverage, because they have options, they have alternatives to renting.
Okay. Now, on corporate performance, BAT Kenya recorded higher profits despite lower net revenue. What factors in this report explain this outcome?
BAT's profit after tax increased by 17% to 5.2 billion, despite a 9.8% decrease in net revenue. This is mainly attributable to 14.6% decrease in cost of operation to 15.4 billion, and also a 123.6% decrease in net finance cost from a net finance loss of 0.8 to a net finance income of 0.2. This together outweighed the 9.8 decrease in net revenue. Also, on the BAT financials, it is important to note that the company announced the final dividend of 60 per share, together with an interim of 10, bring the total DPS to 70. Also, at the same time, they announced total dividend to be paid to be at 7 billion, translating to dividend payout ratio under 3.4%.
Thank you for that, Ryan. That is a wrap for this week's Market Insights. For deeper analysis and weekly updates, check out the cytonnreport.com. Until next time, invest wisely and stay informed.